Exercise 1. Iridium Corporation has spent $3.5 billion over the past decade developing a satellite-based telecommunications system. It is currently trying to decide whether to spend an additional $350 million on the project. The firm expects that this outlay will finish the project and will generate cash flows of $15 million per year over the next 5 years. A competitor has offered $450 million for the satellites already in orbit. Classify the firm's outlays as sunk cost or opportunity cost and specify the incremental cash flows. $3.5 billion already spent is what we call a sunk cost and irrelevant cost. Any previous repairs or purchase of equipment or maintenance that we spent on our current property, plant, and equipment is irrelevant to any future decision we will make. The $350 million incremental cash outflow is very relevant. This is the cash we're going to need if we're going to consider our new project. These are considered a relevant cash flow. The $15 million per year cash inflow is very relevant. Our cash inflows are critical in evaluating the project. Again, we're talking about a future project, a project that's projection, in order to determine profitability using net present value or the internal rate of return. The $450 million for satellites is an opportunity cost and a relevant cash flow. We have two opportunities. One opportunity is to take the offer for $450 million or spend additional funds on our new project. If we forego the offer or the opportunity for a competitor to buy our satellites, that's what we consider an opportunity cost because we selected the other alternative of continuing with our purchase of our equipment for the project. Exercise 2. Landscapes Unlimited has spent $2,200 evaluating a new service area for expanding its business territory. The expansion will require the purchase of a new truck for $35,000 plus fitting the truck with a flatbed that will cost $6,500 to install. The company would realize $8,250 in after-tax proceeds from the sale of the old truck. If Landscape's working capital is unaffected by the project, what is the initial amount for the project? Well, we know if we're talking about evaluating short-term liquidity, we have a formula that is working capital equals current assets minus current liabilities. The greater the dollar amount of current assets over our current liabilities would mean that we'd be able to very easily meet our short-term obligations. Now, in conducting a project, we have to determine inflows and outflows. In order to do this, we use net working capital, which is the working capital of the current year minus the working capital of the previous year. Additional, the change in working capital, or net working capital, is the change in current assets minus the change in current liabilities. And as you can remember from the indirect method when we put together the cash flow statement, when assets increase over time, that is technically an outflow. And when liabilities increase over time, that is an inflow. But when they decrease, that is also an outflow. In order to solve this problem, we have an equation. The initial investment equals the price of the new asset plus installation cost minus after-tax proceeds of the sale of the old assets plus or minus the change in net working capital. When we put the numbers together, we have the price of the new asset at $35,000, the installation cost at $6,500, after-tax proceeds of the sale of the old truck $8,250, plus we don't have any changes in net working capital, so that would be zero, amounting to our initial investment of $33,250. Exercise number 3. Bryson Sciences is planning to purchase a high-powered microscopy machine for $385,000 and incur an additional $31,300 installation expenses. It is replacing the older microscopy equipment that can be sold for $116,500, resulting in taxes from a gain on the sale of $42,600. Because of the transaction, current assets will increase by $11,000 and current liabilities would increase by $5,200. Calculate the initial investment in the high-powered microscopy machine. So in order to calculate the initial investment, we use the initial investment formula equals the price of the new asset plus installation costs minus the after-tax proceeds of the sale of the old asset plus or minus the changes in working capital. So we have to take a couple steps before we can complete the equation. Step number 1 is going to calculate the change in net working capital. Now there's an increase in current assets, and as I said before, when we're putting together an indirect method of cash flows, any increase in assets over a time period would be a cash outflow. Additionally, an increase in liabilities would be an inflow. So if we take our increase in current assets minus our increase in current liabilities, we actually end up with the $5,800 outflow. The next step we must do is complete the after-tax proceeds of the sale of the asset. So as you can see, our sales proceeds is $116,500 minus our tax, because we had a capital gain on this particular asset. It's $42,600. So we take the sale of proceeds minus taxes, and we end up with an after-tax proceeds of asset sales of $73,900. Okay, now we can put the formula together and calculate our initial investment. So we have the price of the new asset is $385,000. We have the installation cost, $31,300. We got the after-tax proceeds of the sale of the old asset at $73,900. We subtract that out. And then we have a cash outflow from the change in our net working capital of $5,800, leading to an initial investment of $348,200. And just remember, when we have an increase in assets over time, it's a cash outflow. When we have an increase in current liabilities from period to period, that's actually a cash inflow. Our next exercise is 4. Birkenstock is considering an investment in a nylon knitting machine. The machine requires an initial investment of $27,000, has a 5-year life, and has no residual value at the end of the 5 years. The company's cost of capital is 10.87%. Known certainties are the actual after-tax cash inflows for 5 years. So they set up expected cash flows utilizing a three-part scenario. We have a pessimistic. Pessimistic is when the economy falls or the industry is like in a slump. Most likely occurs that they're anticipated if everything maintains stability in the economy and in the industry. These are the most likely cash inflows they will receive on this project within the 5 years. And an optimistic viewpoint is if the economy grows or they make additional sales, they're looking at gaining greater numbers. So that's the difference. You want to set up the three scenarios over the course of the 5 years. So within these three scenarios, we're going to calculate the range of net present value, giving each scenario a value. And the value we're going to consider is the cash investment of $27,000 outflow minus the present value of each of these scenarios inflows. So the net present value is the present value of the cash inflows minus the upfront project cost. The present value of cash flows may be found using the Excel spreadsheet NPV command. Now we'll use the present value command when there are even cash flows. When there are uneven cash flows, we use the NPV to determine the present value of those cash inflows. If we use our formulas in Excel, because of the uneven cash flows, we use equals NPV. We're going to put our discount rate in there, cost of capital, at 0.1087. And then our rows here, 1 through 5, were my rows in Excel, E3 to E7, so they're the same numbers. My output for the present value of an even flow of inflows, of cash inflows, was $26,968.29, as you can see up above. So to obtain the net present value in a pessimistic case, we would take the $27,000 minus our present value of inflows, $26,968.29, and obtain a net present value. Now this is net present value of negative $31.71. We have to take our present value of the cash flows minus our outflows. Now we do this for the most likely and optimistic in Excel. When we get our values for our net present value, we subtract the high from the low. Since the low is a negative number and our optimistic is positive, when we subtract the 19,595.55, we subtract it from negative 31.71. Obviously, we get a positive number. Therefore, the NPV range is 19,627.26. Okay, let's go over to exercise E5. Like most firms in the industry, Culinary Cafe uses a subjective assessment tool of its own design. The tool is a simple index of the projects are ranked by the level of perceived risk from 0 to 10. So risk project PITA once again requires an investment of $12,500 and is assigned a risk index of 6. 6 would be equated to a required rate of return of 7%. So because it's less risky, the required rate of return is less. Project Grape Leaf requires an initial investment of $7,500 and is assigned a risk index of 8. Now, 8's a higher risky project that they feel, if we go with the Grape Leaf project, higher risk, which means they would need to have a greater required return percentage. In this case, it would be 8. PETA is projected to have cash inflows of $5,500 per year. Grape Leaf is projected to have cash inflows of $4,000 per year. Use each project's RADR to select the better project. So we're going to use 7% in calculating the discount rate for Project PETA and 8% for Grape Leaf because it's a more riskier investment. Now here we have the values for both Project PETA and Project Grape Leaf. We use 7%, the period 7 years, and we have even cash inflows of $5,500, which makes things easy. So we can either use the present value of annuity formula, which I have here, plugging in the payment of $5,500, the number period 7, and the RADR of 7% are, or we could utilize the PV formula in Excel, plug the values in for the required rate of return, which is 7%, the years, which are 7, and the cash inflows, which we have to use a negative, which in our cash inflows in the Excel spreadsheet formulation to derive at a positive present value of $29,641.09. So either way you calculate the present value, once you calculate the present value of the cash inflows, you subtract them from the initial investment to achieve a net present value, or NPV, of the project. And Project PETA has a $17,141.09 return, where if we calculate Project Grape Leaf with steady cash inflows of $4,000, initial cash outflows $7,500, our present value would be $20,825.48. And if we subtract that from our initial investment, we derive a net present value of $13,325.48. So Culinary Cafe should select the Project PETA because it has a higher net present value. Moving on to exercise 6. Same type of thing. We've got two projects, initial investment. When we have cash inflows over 2 periods, we have initial investment of outflows, Project S, Project T. Right? Which project would we recommend? And in this particular case, 50 Cent is hired you to advise the firm on capital budgeting, issuing 2 unequal-lived, mutually exclusive projects, S and T. The cash flows for each project are presented in the following table. Right, our cost of capital will be 9%. All right, let's put the numbers together. Before we conduct our analysis, I just would like to explain annualized net present value. And its approach used in finance to evaluate mutually exclusive projects with different lives. Here we have a 3-year inflow return, and our other project, Project T, has 7. So what it does, it converts the net present value of unequal lived projects into an equivalent annual present value. We conduct the same type of calculation for project T, and we end up with our net present value equating to $39,855.87. Now there are two steps to obtain the annualized net present value. The first step is to calculate the net present value of each project. The next step is to calculate the annualized net present value. And in order to do that, we use the PMT equation in Excel. We apply the discount rate, the number of periods, minus the present value. We've calculated the present value, or the net present value of our project. And instead of the present value, we're going to use the net present value. So we have project S with a 9% cost of capital, a 3-year project, and our net present value of $23,406. You have to remember to put the negative sign in there. We do the same thing for project T. In Excel, we use the equals PMT formula. And we're going to calculate, again, these final calculations, the 9,246.68 is what we call the annualized net present value. So, in studying both of these independent projects with different lives, mutually exclusive, meaning we're only going to take one or the other, which one would max shareholder wealth? Given the projects are mutually exclusive, only one can be chosen. 50 Cent should choose project S because of its higher annualized net present value. So to recap, in order to calculate annualized net present value, we use a two-step method. The first step is to find the NPV, which we have done, of both projects. And the second thing to do is find the annual cash payment, the annuity, that would generate from those net present value projects, the two projects, for the respective lives of 3 and 7 years at the cost of capital at 9. So after we calculate the net present value, we plug it into our formula to calculate payment. We have a discount rate, number of periods, and present value. We plug our present value as being the net present value, the cash inflows minus the cash outflows. We have to remember to put the negative sign in order to derive our annualized net present value. Sunk cost and opportunity cost. Masters Golf Products spent 3 years and $1,000,000 to develop its new line of club heads to replace a line of its becoming obsolete clubs. To begin manufacturing them, the company will have to invest $1.8 million in new equipment. The new clubs are expected to generate an increase in operating cash flows of $750,000 per year for the next 10 years. The company has determined that existing lines should be sold to a competitor for $250,000. And this is problem number 3 in chapter 11. So we have two questions. How should the $1 million in development costs be classified? How should the $250,000 sales price for existing line be classified? Okay, the $1 million development cost should be considered part of the decision to go ahead with the new production. This money has already been spent and cannot be retrieved. It is irrelevant and therefore a sunk cost. However, the $250,000 sale price of the existing line is an opportunity cost. If Masters Golf Products does not proceed with the new line of clubs, they will not receive the $250,000. Okay, let's move on to problem number 7. Change in net working capital calculation. Samuels Manufacturing has considered the purchase of a new machine to replace one it believes to be obsolete. The firm has total current assets of $920,000 and total current liabilities of $640,000. As a result of the proposed replacement, the company has following changes that are anticipated in the levels of current assets and current liability accounts. Using the information given, calculate any change in net working capital that is expected to result from the proposed replacement action. Explain why a change in these current accounts would be relevant in determining the initial investment and the proposed investment project. And number 3, would the change in net working capital enter into any of the other cash flow types that make up the project's net cash flows? Explain. So we have our data here. We have accruals. We have the change in accruals. We have marketable securities. We have the change in inventories, the change in accounts payable, no changes in notes payable. We have accounts receivable, there's a change. And cash, there's a change. So setting our current assets and current liabilities as a balance sheet, we come up with our current asset net change of $155,000 and our current liability change of $130,000. If we plug in the formula for net working capital, which equals our current assets minus our current liabilities, we get a cash outflow of $25,000. All right, remember that any increase in assets during a time period is an outflow, but an increase in liabilities is an inflow. So the analysis of the purchase of the machine reveals an increase in net working capital. The increase should be treated as an initial outlay and is a cost of acquiring the new machine. Yes, in computing the terminal cash flow, the net working capital increase should be reversed.